Hey everybody, Chuck here. We're here for the third episode of our I Don't Want to Wait 48 Years to Learn What You've Learned. And we're going to be looking at the financial section, hanging out at a Starbucks here on a cold, windy day here in Minnesota. So hanging out where it's warm here. So let me share the screen with you. We're going to look at the finance here. And let me take you through today's story here. I'm going to bring up our leadership mind map, and we're going to move over to the area of financial management over here on the upper left corner and look at the three basic financial statements, so balance sheet, income statement, cash flow, and kind of what the lessons learned we can have there. And many of us know what those are about, but at the same time, we kind of take them for granted and don't do as much. So let me share with you my lessons learned. Let me bring up to you here then on the screen. I'm going to use the Flexi simulation, the supply chain simulation that I use in my training. And we're going to go back to round six. And I'm going to bring up over here on the left balance sheet, then profit loss statement, and cash flow. Okay. So looking at the balance sheet, we often talk about balance sheet as assets and liabilities and equities, and they have to own it, they have to equal each other. And we think of assets as things that we own, liabilities as things, and equities as things that we owe. Okay. Now, the aha for me is to look at it a little differently. It was probably about 10 years ago. Had a CPA say, Chuck, there's a better and different story for that. Don't think of assets and liabilities. Don't think of liabilities as what you owe, but think of it as where does your money come from? And assets as where do you spend that money? Or how did you spend the money that was given to you? So if you look at our balance sheet, we see in this example, lots of cash, lots of equipment, very little inventory that we see below. So like our overview shows, we kind of have a consultant report after each round to help the learners think about things. We see things like heavy reliance on plant investment, virtually no liquidity or inventory, and what the risks are and recommendations. So what I want you to think about when you see a balance sheet is don't think about what you own and what you owe, but where does your money come from and what the ramifications are and what you do with that money. How do you deploy it as an asset and what does it mean for you? Going over to the profit and loss statement. We always talk about, revenue minus expenses equals, whether or not we made money. And that's true. But again, looking at the income statement, here is our revenue. We do it a little bit differently here. We're not generally accepted accounting principles format, but we break it out into variable costs and fixed costs, so we can do break-even analysis. But fundamentally, what we're looking at is, when we get to the concept of gross margin, what I want you to think about is money I made from manufacturing. Okay, is it enough? So we can make money from manufacturing, but if it's not enough to cover all our expenses, then we end up at a loss. And so we don't make enough money from manufacturing to be able to support the whole business. Now, the flip side, if you think about that, is I can lose money at the gross margin level. I'm not making enough from manufacturing, but I can still have a profit at the end because accounting wise, I could sell an asset and that could cover my costs. But the problem with that is, it's like having, a paycheck where you make money, but it's not enough to cover your bills. And so you have a garage sale or a sale of some of your goods to pay your bills, but long term, that's not sustainable. So we have to make enough from manufacturing to be able to pay our bills without having to be able to, sell off assets. Another part of it also is when we get down to the bottom, the other aha is the net income in the bottom. Okay. A couple things to think about there. The same account said to me is, well, that's great. You got net income, but number one, is it enough to reinvest in the business? Because if you can't reinvest in the business, you're not going to be able to grow the business. Number two, is it enough to keep the owners interested in keeping the business? And I resonate with that because I remember back in the late 70s, early 80s, when inflation was really high, you could put money in the bank in a certificate of deposit, make 15, 20%. And, inflation was 15% at that time. And the challenge was a lot of business owners looked at it and says, oh my goodness, I could put money in the bank. You get a 5-year CD for 20%, and I'm only making 6% from my business. Why am I knocking my brains out? So they'd sell the business. So the net income has to be enough to keep the owners interested, as well as being able to um, grow the business. So you got the owner's interest, grow the business. Cash flow does not get looked at anywhere near enough as we should. Cash flow looks at, money coming in and money going out, and what's the balance for us. The idea here is trying to answer the question that says, where did my money go? All right. So we run into that over the course of our budgets at home, of course. Get my paycheck, spend money, don't have a budget. All of a sudden, my cash flow goes down. I'm in trouble, etc. We should do the same thing here too. We should look at all the changes in the cash flow on all the different areas and be asking ourselves why. So in our example here, because we have been asking why, we are seeing we're seeing the impact on our cash flow, and it's going negative. So we need to go in and figure out what's going on and understanding the risk. So as you look at your cash flow, the lesson learned for you and I, the one that I had, is when a number changes in my cash flow, I want to start brainstorming why. Okay. My cash for inventory went down. We might think that's good, but it could be bad because I'm not buying as much. It could be good because costs went down, or I got rid of scrap because I don't have as much scrap. I don't have to buy as much inventory. So that's a good thing. So asking why helps us understand not only what happened in this situation, but gives us a better grasp on the business. So, we take those three statements for granted, but diving into them is a good lesson learned. Where's my money coming from? What did I do with it? Am I making enough to reinvest in the business, keep the owners interested? And why did my cash flow change? So we're trying to understand what's happening